contrarian, leave it to contrarian badass Reggie Middleton. He called the housing crash, he called the collapse of Bear Stearns and Lehman Brothers, and the crisis in the Eurozone banking system. Reggie Middleton.
Relationship to each other and institutions has predicated and grown this market in a pretty powerful way. I don't think it's all of it, but I think it feels like a lot of it. And that means that we're innovating in a way that we haven't before, and so that the outcomes will be very different. So what happens to our verticals, what happens to our sectors, what happens to our business models as a result of this innovation around changing the way we think about trust will have repercussions we don't know yet, and so it opens up a whole lot of possibilities. So that all sounds very high-minded, and but that's kind of my role in this panel. So yeah.
Reggie or Crow, anything on that subject? I'm going to leave that one myself. So there's a couple areas that finance and insurance are sort of staying away from cryptocurrency at this time. One is the credit system. There really isn't lending being done with cryptocurrencies yet. And the other is potentially even more interesting. It's really the institutional side. So the question here that I have written down is, what are those barriers for institutional access to cryptocurrency? Krill,
sure.
Take that.
So the market is still very inefficient. There are some lending markets, but if you look at the cost of capital on some of these tokens and projects, it goes up to 25 or 50% annualized, which is absolute lunacy if you compare it to traditional assets. Cryptocurrency in general does not play friendly with asset classes. Your vendors don't support it. It needs its own security infrastructure, which becomes one of the most important pieces of your overall operations. Third-party custody is still a question, because if you're trading securities, they need to be custodied by a third-party custodian. And in this space, our fund is avoiding securities because we don't think that there's any qualified third-party custodians. And then you have concentration risk on that custodian as well, which is another issue. So the cybersecurity of it all is functionally, you have to manage the PIN code for your bank account. And you have to make sure that there's no way anyone has access to it, because once someone else does, it's gone. So risk and analytics tools are just starting to get built today. I'm speaking to people that are literally building it from bottom up at this point, because this doesn't show up on your Bloomberg terminal outside of maybe Bitcoin, Ethereum, and whatever tracking ETN is out there in Europe. You need to sort of rethink your entire investment infrastructure to get exposure. Personally, I think that the easiest way today to sort of play in the space, if you want to just buy and hold Bitcoin, there's a few easy ways to do that. If you want broader exposure to sort of alpha generation, then it's as an LP to a fund, like Full Node. But it's generally very hard, and it's something you really have to think through. Everyone's actually watching this space. Two Sigma's watching this space. I think Goldman, there's some news around them possibly launching some sort of market-making desk. I mean, Credit Suisse was holding an investment conference 2 weeks ago. Custody is a massive revenue opportunity for banks. Market making is a massive opportunity for funds and banks. I think SIG's been in the Bitcoin space for years at this point. And a couple of other major prop shops. So it's just a matter of how well these institutions are able to innovate and sort of get from point A to point B on the sort of roadblocks that management imposes, because this is an incredibly lucrative field from the service provider side in addition to the fund management side, but you just have to be in the position to sort of create and develop that infrastructure, which is sort of ground up.
So do you think that the interlinks for the cryptocurrency and the traditional asset classes are going to be the banks themselves, or are you viewing like an ETF that actually sort of brings them together in an investable type of way?
I think the interlinks go even beyond that. In the future, you're going to have tokens that are backed by deliverable commodities that you can trade against futures. You have public equities, even today in Australia and Canada, that are launching ICOs. Figure out how much they're likely going to raise and how creative that is to a balance sheet. You can run your traditional DCF analysis. It goes into the individual business process of every single company, possibly in the world, if it makes sense for them. So in the future, I see cryptocurrency not just affecting sort of cryptocurrency companies, but traditional companies, their institutions, and you're sort of going to have to analyze how tokens play a role within that capital structure.
Okay. So that's the market is just enormous. There's no question about that. Let's go to Q&A.
Hi. Risk analysis and evaluation is the meat and potatoes of what most people do in this room, in that your transactions are completely anonymous for the most part. How can you conceivably say that you know how many transactions actually result in the exchange of tangibles as opposed to cryptocurrency becoming a self-fulfilling prophecy of people trading it for speculative purposes? How much of this actually ends up being a home, a car, land, business, food, something tangible? Do you have any way of measuring that?
Well, I'm gonna give that to Krill, but I'll point out one thought, is that I think that part of the paradigm shift that blockchain is driving is what is really I think it's the transaction that's actually becoming important, and not necessarily the value or who's transacting it. Or if I design a trusted consortium for selling automotive vehicles, as you suggested, and all of a sudden I acquire all of the transactions, what's really the value? I mean, there's more value there than the actual product. That's in my high-level perspective.
So the way I like to look at it, I kind of look at it from a modified quantitative theory of money approach. So you sort of have individual use case, which represent certain transactional demand, and you can divide that by the velocity of money, so how quickly these tokens can be used to achieve those functions and sort of the outstanding tokens in the industry. In real time, you can't, because if you're talking about new wallets, you can have a $200 million movement or $1 billion movement, and it's just an exchange sort of moving around its money for its own operational purposes. So it's tough in real time, but you can plug in your own sort of assumptions of industry growth, and there's a few other ways of doing it. Some people look at Metcalfe's law, which is around network effect and the number of network participants, sort of measuring a correlation between that and future price as well. There's a few different ways people are looking at it.
Hi, I have a question for us. Could you just tell us a basic concept of Bitcoin? Because to me, Bitcoin is just something that is common for all the currencies. And if you could just give us a basic understanding of that, that's number one. Number two is you also mentioned artificial intelligence. And I think that this is something that has an incredible growth potential, artificial intelligence. But how do you connect the two?
I'll take the second one if someone else wants to take the first.
I'll do the first one. Okay, remember, the Bitcoin is an application built upon framework. Framework, the infrastructure, is the blockchain, the Bitcoin blockchain, the application, which is, in this case, a digital currency, and there are many. This is just one, right? Okay, this application is a digital currency application. Think of it as an account of value. There's a ledger. You have one Bitcoin. I send one Bitcoin to him. It goes through the blockchain. There's a permanent record of it that everybody can see. The assertion that Bitcoin, these digital currencies, at least Bitcoin, is anonymous is not true. That's something that was fostered by the media. It's pseudonymous. It's attached to a 26-character alphanumeric string. And it's attached to that, so everybody can see it if they look at the transaction. Now, that's all it is. It's a unit of account that serves as a currency, but unlike fiat currencies, which are called dumb currencies, this is a smart currency. This currency has its own transportation rails, called the blockchain. Okay, these transportation rails don't obey geopolitical boundaries. They could go over water, over land, through Russia, through China, etc. They don't obey socio-political norms, socio-economic stratification. So it's sort of a magical currency. It's also a currency that heretofore has a transportation rail that has never been compromised. Compare this to fiat currencies. The fiat currencies are compromised regularly. Your wallet, and everybody here has a digital wallet, it's called a bank account, okay? That wallet, the custodian of that wallet is usually compromised regularly. I think James Dimon said that JP Morgan gets over 100,000 hack attempts per day. There's no telling how many times it was succeeded. But if you follow the, forgot the name of it. There was one hacking with the social engineering malware, and they stole billions of dollars. The central bank, the New York Federal Reserve was hacked. It was member banks. Almost every major financial institution has been hacked, except for Bitcoin. So, without going into the valuation argument, these are some of the characteristics that make it different and special. And it's programmable, so you can do additional things with it. And that's one of several other products and several other trades. But in short, it's a digital currency application, an account of value that has its own transportation rails, and that doesn't have to adhere to any of the legacy norms that affect fiat. Its governing agency is math. So as long as 2 + 2 = 4, this transaction should work. Fiat is backed by the full faith and efforts of the US government for the US dollar, or JMD, like Jamaica, the yen, etc. Those rise and fall, and if you look at any fiat currency over time, by default, it loses its value. If you compare Bitcoin in 2009, the US dollar, which is the reserve currency of the world, in 2009, go up to 2017, US dollar has lost X%, euro, pound, etc. Bitcoin has went from 0.02, 2 Bitcoins per penny to 6,000 and change. That's because of the deflationary nature of the application. Did I answer your question?
Yeah.
And to the second part,
Yeah, artificial intelligence.
artificial